The deep dive mission today is pretty straightforward. We're looking at Vertiv Holdings, ticker VRT, and their Q3 2025 earnings call. And look, this was fundamentally one of the most remarkable reports of the entire quarter. A colossal beat across every single metric, really driven by that relentless accelerating demand for AI data centers.
Exactly. I mean, the underlying data, it just screamed blowout quarter. But the trading action on the day was completely counterintuitive. The stock, it spiked sharply pre-market, then just faded all day. It actually closed down 1.8% despite these stellar results.
It was bizarre. It was a confusing day for one of the market's biggest AI infrastructure plays.
Yeah.
If you're looking for a perfect case study in market dissonance, that disconnect between fundamentals and price, this is it.
For sure. So our job here is to cut through that noise. We're going to unpack the record results that Vertiv put up and then try to explain that odd gap. Why did the market flinch when the company delivered, truly exceptional numbers?
Okay, let's start with a pure signal, the headline figures. This wasn't just a cyclical lift. This was a convincing beat. Adjusted earnings per share, or EPS, landed at $1.24.
And that was against a consensus that was hovering right around 98 cents to $1. So that is a substantial, 25% beat on the bottom line. It's huge.
Yeah, and that beat flowed directly from the top line. The revenue growth was incredibly robust. It came in at a strong $2.676 billion.
Which beat the street by about 90 to 100 million bucks. And it represents a massive 29% growth year over year.
Okay, but here's where the quality of the beat really shows up for me. Profitability. Adjusted operating profits soared to $596 million. That's up 43% year over year, which led to an adjusted operating margin of 22.3%.
And that 22.3% margin figure, that tells a critical story. That's a 220 basis point increase from last year, and maybe more importantly, a huge 380 basis point jump just from last quarter. It really confirms that their operational improvements are moving faster than even they guided.
But the number that confirms the entire thesis, that Vertiv is right in the epicenter of this AI build-out, is demand. Organic orders grew a phenomenal 60% year over year. 60% for a company this size is absolutely massive.
It is, and it's not just the year over year number. Orders were up 20% sequentially, quarter over quarter, and when you connect those orders to sales, you get a book-to-bill ratio of roughly 1.4 times.
Hold on, let's just clarify that for anyone who might not be tracking industrial metrics every day, what does a 1.4 times book-to-bill ratio actually mean for Vertiv?
It means that for every dollar of product Vertiv shipped and billed in the quarter, they brought in $1.40 in new binding orders. Put simply, they're building demand 40% faster than they can currently fulfill it. This basically proves that revenue growth is structurally supported deep into 2026.
And all that demand, it just feeds right into their backlog. Their total backlog is now at a staggering $9.5 billion, which is up 30% year over year. That backlog, it's like an ironclad guarantee, right? It gives them strong visibility well into 2026.
That visibility is a core asset. Now, drilling down a bit, that margin expansion we just talked about, it wasn't just about raising prices. Management said this was also superior execution. They're getting those supply chain issues sorted out faster than they thought.
We should probably also highlight the cash position, which gives them a lot of strategic comfort. Adjusted free cash flow was $462 million. That's a 95% free cash flow conversion rate, which is just high-quality cash generation.
And their balance sheet is immaculate. They ended the quarter with net leverage at a lean 0.5 times. They expect to exit the year at an extremely low 0.2 times. This gives them immense flexibility for, investments, capacity, or even M&A.
And speaking of confidence, they backed it all up by raising the full year 2025 guidance. They're really putting their money where their mouth is.
Absolutely. Net sales guidance was raised to between 10.16 and 10.24 billion. That's organic growth of 26 to 28% for the year. And crucially, the adjusted EPS midpoint was raised to $4.10. To put that in perspective, that represents a 44% improvement over their 2024 results.
Now, regionally, this AI acceleration isn't happening everywhere at once. The Americas are the clear engine. Organic sales there were up a phenomenal 43%. And management pointed directly to AI demand for liquid cooling and high-density power. APEC was also strong, up 21%.
But the story wasn't perfect, and this is probably where some of that stock weirdness comes from. The soft spot is still the EMEA region, so Europe, the Middle East, and Africa. Organic sales there actually declined by 4%.
That's a material drag. And management was pretty direct about why, right? They cited power availability issues and some complex regulatory challenges in Europe. They don't expect a real reacceleration there until the second half of 2026.
Yeah, and this raises a question about strategy. They announced a global restructuring program, mostly to right-size that EMEA footprint. It comes with a $30 million upfront cost. So given the weakness, are investors questioning if the expected $20 million annual benefit from that is worth the $30 million outlay right now?
That is exactly the kind of friction point an investor would look for. But the fact that the full-year guide was still raised so much confirms that the Americas are just overpowering that EMEA weakness.
Which leads us right into their forward strategy. If Q3 was about execution, the next phase is about aggressive investment. They made it clear they are not just riding the AI wave, they intend to lead it.
They're committing huge capital to capacity expansion, trying to stay 6 to 12 months ahead of the demand curve.
Yeah.
Especially in the Americas. And what's interesting is their approach. They prefer growing existing sites instead of building new ones from scratch.
That's a speed play. It's much faster to build out an existing site where you already have the teams, the processes, the supply chains. It minimizes risk. And in AI infrastructure, speed to deployment is everything.
And it's not just about manufacturing. They're accelerating their intellectual capacity. Engineering and R&D spending is expected to grow over 20% in 2026. And they explicitly said they can accelerate that even further if they need to.
And here's where that technology moat really shines. Vertiv announced they're developing an 800-volt DC power portfolio. It's planned for a second half 2026 release. Why is this so critical? Because it aligns perfectly with the 2027 rollout of NVIDIA's next-gen platforms, like the Rubin Ultra.
So they're designing for a GPU chip that doesn't even exist yet. That's really thinking ahead. But for listeners who aren't electrical engineers, why is 800-volt DC a game changer for AI?
Well, as rack power density just explodes, we're talking 100 kilowatts per rack, maybe more, you need to move that power efficiently. The 800-volt system doubles the power capacity of standard systems without needing thicker copper wire. This cuts material costs, minimizes power loss as heat, and it makes integrating liquid cooling much simpler. By solving the power problem for the next generation of AI, they create a huge barrier to entry for competitors.
And that advantage goes beyond hardware. Management spent a lot of time on their services business. They called it their superpower. This is the recurring revenue that follows all that complex hardware installation.
And they are building that moat aggressively. Their field engineer headcount is already over 4,400 and growing. And the recent acquisition of Waylay NV, which is an AI software company for predictive maintenance, directly helps this. I mean, think about it. You have complex liquid cooling, 800-volt power. You need sophisticated AI to predict failures. Waylay guarantees that stickiness.
We do have to acknowledge the headwinds, though. Management flagged new tariff impacts, specifically Section 232. That did create a slight headwind on their Q4 margin guidance.
It's an unavoidable cost right now, for sure, but they laid out a really clear action plan. They expect to materially offset the tariffs through a combination of shifting production and pricing programs, and crucially, they expect to fully absorb these costs as they exit the first quarter of 2026.
That quick turnaround, absorbing external costs within 2 quarters, that signals real pricing power.
It definitely does.
So we circle back to the central contradiction. Phenomenal results, massive AI orders, aggressive investment, yet the stock closed lower. Beyond just sell the news, what deeper skepticism is the market showing here?
I think the reason for the fade is really twofold. First, the profit-taking is real. Vertiv has been a spectacular performer, up over 50% in the last year, crushing the industrials ETF. A high valuation often leads to volatility around an event, no matter how good it is.
Okay, and the second point. What's the more nuanced bear case that would make someone sell?
It likely revolves around the sustainability of both margins and the spending. The market might be skeptical that Vertiv can hold a 22% margin while simultaneously pouring all this money into capacity and R&D. Investors worry about front-loaded spending hitting near-term profits.
So the skepticism is less about the demand itself and more about the cost to capture it.
Precisely. They're betting the margin improvement will slow down even if growth stays massive. But Vertiv's long-term target is clear. They reiterated 25% adjusted operating margins by 2029.
There was also a really good question about that $9.5 billion backlog. Does that number actually capture those massive multi-gigawatt deals we read about?
And that detail is very reassuring. Vertiv calculates its backlog based only on legally binding purchase orders, or POs. So those huge multi-year 10-gigawatt projects, they don't hit the backlog all at once. They flow in phases. So as the next 250-megawatt chunk of a bigger project is ready to go, that's when the PO hits Vertiv's backlog.
So the $9.5 billion is confirmed executable demand. And it confirms there's an even bigger pipeline behind it that hasn't even been converted to POs yet.
That is the critical takeaway. The pipeline is robust, and the current backlog is high-quality, executable revenue.
Which all suggests that the market volatility really is a short-term thing, probably related to valuation and timing, not a fundamental flaw.
That's the signal we get from doing a deep dive on the call, yes.
And now we reach the part of the show where we talk about an outrageous but plausible trade idea. And let me be absolutely clear. This is not financial advice. We are not telling you what to buy or sell. This is purely for educational and entertainment purposes.
Please, do your own diligence and consult a professional before making any investment decisions.
Okay, so the premise of this trade is what we're calling the services arbitrage. The stock's choppiness reflects doubt about the hardware cycle after 2026. The market is pricing in risk, but the high-quality service revenue VRT is building. That is nearly guaranteed. The complexity of this new infrastructure all but ensures it.
So the idea here is to capitalize on that near-term risk while you secure exposure to the long-term services moat. You could, for instance, sell 2026 call options at a high strike price. You're basically monetizing the volatility premium, betting on continued choppiness.
And then simultaneously,
You use the money from selling those options to buy long-term 2027 APS. Leaves are just long-dated options, so you're placing a long-term bet on that core story. It's a bet that the guaranteed service pull-through makes any current pullback a great entry point for that superpower moat.
so you're selling the short-term uncertainty to fund a bet on the long-term certainty. It's a structurally sound way to play a temporary wobble.
It's a plausible path if you believe in that service moat and their execution.
To recap, Vertiv delivered a massive Q3 beat. Adjusted EPS of $1.24, they raised the full-year guide to $4.10 and saw AI-driven orders grow 60%. The core story is strong execution, great margins, and robust investment in R&D and services, specifically with that 800-volt portfolio for 2027. The only friction is really the EMEA softness and navigating tariffs.
Yeah, the key is the strategic confidence. You see it in that 20+% acceleration in R&D spending. They're spending today to capture market share for the next decade.
And that brings us to our final provocative thought for you to chew on. If Vertiv successfully offsets all these tariffs as they exit Q1 2026, the question is, will this aggressive investment cadence in R&D and AI-enabled services let them hit their 25% margin target sooner than 2029? The cycle is accelerating. So is their strategy.
The whole story will hinge on execution over the next 4 quarters.
Thank you for joining us on this deep dive into Vertiv's performance. We look forward to having you back for the next one.